All right. What's up, everybody? Happy Wednesday. Welcome to another episode of What the FICC, the show where we talk fixed income, commodities, and currency. I'm Spencer Israel, joined as always by the head of FICC and All-Star Charts, Mr. Ian Culley. Ian, how we doing today?
Excellent. How's it, everybody?
We are doing well. We're doing well. We're doing better, I suspect, than some areas of interest in the market that you watch. Let's talk about gold here to start this show off. The question of the day, the question that I made the show: how low can gold go? Last week, you and I discussed gold being at a key level of support from 2011. Well, how are things right now?
Well, the bulls are stepping in and supporting higher prices. It's really interesting to see. First chart here, highlighting those 2011 highs. This is the peak from the prior commodity super cycle, approximately 1924. Bulls stepped in just above that price and are supporting price here. Zooming in over the past 2 years, if we lose this 2011 peak at 1924, I think the next logical level of potential support is around 1825. This is a key retracement level from this consolidation here. And it's also marked by the pivot highs from last August and the pivot lows from earlier this year. So it's also a polarity zone. So I like the action. I like that there's some price memory here, and it's a key retracement level. So if and when we lose those former highs, I think this is the next logical level of support. What's interesting is another polarity zone here, a little more tactical, shorter term. Now, I don't know what's up with the data here for these gold futures charts. I don't think it's been rolled over to the most active contract, which is now the August contract, because August contract right now, as of this live recording, is trading at 1990, excuse me, and a half. So bulls stepped in, have reclaimed this 1975 level. So as long as that's the case, I mean, zooming out, intermediate or longer term perspective, it's still a sideways range. It's still this big structural basing pattern, but that near term weakness, that near term neutral to bearish bias is starting to flip higher again. The bulls are starting to take control. So as of right now, I look at gold, I look at precious metals in general, and I just see some constructive basing, nothing to get all worked up about. Just give gold and precious metals some space to dance.
All right, a little bit more bullish than I was expecting from you today.
Well, that's the data that's coming in right now. I didn't, bulls, kind of were dancing around this 1975, 1977 level, and now they're really driving prices higher. I think we're starting to see rates roll over today. Crude oil's getting hit. That's also definitely a big topic right now. And I'm also peaked at some monthly candlesticks. I know we've got what 5 more hours, 6 more hours before this actually prints here. But notice this key level for GDX. When we look at the monthly candlestick chart around 30, I mean, it's holding there now. So this is a logical level to see bulls step in, support price at this shelf of former highs. So ball still in the bulls' court. They've definitely experienced some near-term selling, but
maybe I should have called the show "How Low Can Oil Go?" Let's bring up the oil chart. Man, what do you say about this one?
Potential top here. Maybe see a multi-year head and shoulders top. I don't want to get too caught up on the actual pattern names here, but definitely potential topping or distribution pattern here with a neckline or support level around 65. Zooming in on the daily chart, we were watching around 74. See if we get that 74 handle. We prove that the bulls were we're getting back in gear. That never happened. Found resistance, and now still within a bearish momentum regime. Yes, we got a little bit of a bullish divergence in the 14-day RSI, but it's still square in the bear's court here. So eyeing that 65 level, lower bounds of this range. Below there, crude oil most likely headed towards 45. At least that's the next logical level of potential support. USO oil ETF, that level's 58, 58 and a half. And I marked those October pivot highs from last year. It wasn't long after the dollar peaked. So let's see. Below here, below 58, and the path of least resistance is lower. I'm moving on to copper, another pro-cyclical commodity. It's actually digging in. This is a new look here. There are a lot of different looks for copper. I want to change it up a little bit, zoom out a few years. Thinking the extension levels from that 2019 to 2020 base here. Now, this is that last little basing pattern before copper and commodities really started to rocket higher at the end of 2020, in that November. Now, that's levels around $3. I think the bigger levels around 330 when we look at the prior cycle peak from 2018. But we are seeing some action around the 161.8 retracement level, right? Acted as support here after price blew through that level back in early 2021. That's interestingly, price is finding support there around 350 now. So as long as above 350, I mean, we're just seeing a little pullback here for copper. I think copper getting back in gear would be a big deal. What's that?
You know, it just seems like every commodity is experiencing that same short-term pullback right now.
Yeah, absolutely. I think commodities are under pressure. Just more broadly, commodities are under pressure. We are seeing some risk on developments across the market, but it's not in the commodity space. Now, there are those pockets of strength, like live cattle are breaking to new highs. Sugar consolidating within a bullish uptrend. We've seen some strength in cocoa, but overall, a lot of weakness. Looking at FCX, Freeport-McMoRan, never really broke down. We got a little tight bullish divergence on the 14-day RSI. So some improving momentum, still in a bearish regime. But this is good news for bulls. Good news for copper to see FCX holding above that 33, let's call it 35 level. So I think a lot of it has to do with interest rates. We've been talking a lot about interest rates. We were chatting about interest earlier this morning. And we look, tactically, when we zoom in over the past year, it's really a range-bound mess. They're really just chopping sideways. It's really hard to take a directional up or down, higher or lower call for interest rates. Right now, the trend is sideways. It's interesting, over the last, 6 months or so, you see the 30-year, this is earlier this week, pulling back to those pivot highs, going back to the beginning of the year, whereas the 5 and the 10-year not quite making it up to retest those pivot highs from March. So maybe this is just a signal that rates are going to start to roll over, possibly break down. And I think in that environment, crude oil will likely struggle, and commodities, pro-cyclical commodities in general, will struggle in that environment. Moving on to the dollar, moving on to currencies. I shared this chart a couple of weeks ago. The dollar yen breaking out. Look at this. These 3 charts have been moving together for well over a year. This is the dollar yen, the US dollar index, and the 10-year yield. Dollar yen breaking out. Dollar index not quite getting back up to that 105 level, and the US 10-year yield finding resistance. And I know we don't normally talk resistance and support when we talk about rates, not actually traded, but they are tightly wound towards bonds, which are traded. So I'm going to go ahead and call this resistance. No, interesting to see whether or not rates and the dollar follow higher. For now, the answer is no.
Now, why don't you use support? Is it just because the ranges are so tight?
when talking about interest rates,
Yeah.
because they're
Yeah.
not actually traded directly.
Okay.
They're just yields. We talk support and resistance, and we talk about the actual bonds that are traded, but they interact, and they're so tightly,
Yep.
connected that I call them. I still use those terms when talking about yields. Looking at the dollar, that 105 level. All right, we've talked about this before. As long as the dollar is below 105, buy stocks. Right? Pretty simple, straightforward. Still below 105. Right? Haven't gotten back above 105. Have we seen evidence start to turn and flip in favor of a potential US dollar rally? Sure, but none of that really matters until the dollar gets back above 105. For now, like interest rates, still churning sideways. And like the 5 and 10-year yield, starting to turn lower here without actually retesting and challenging those pivot highs from March to take note of. On the other hand, looking at the US dollar index UUP, it did get back up to those March pivot highs, and it also registered an overbought reading on the 14-day RSI. This is actually never hit oversold. So this is an indication that the bulls are still in control, and that we could see some more upside potential in the coming months for the US dollar index fund. But I'm keeping an eye on DXY. Keeping an eye on DXY. I want to see DXY confirm the action in UUP before I start making any strong claims with conviction. Another one data point that I think is really interesting is that when we add some commodity-centric currencies to the US dollar index, in this case, our G10 ex-US currency index includes the Norwegian krona, the Aussie dollar, and also includes the New Zealand dollar. So when we add these commodity-centric currencies, we're getting a higher high and a higher low, right? While the US dollar index prints a lower high and potentially two lower lows and potentially a lower high.
These charts look the same to me.
Yeah, they are very similar, but there are divergences at times. You can see that divergence back in 2015, where the US dollar index was kind of chopping sideways, making a slightly lower high, while this G10 ex-US index was making a higher high, continued to catch higher. That ultimately resolved in the direction. Ultimately, they both caught lower following the US dollar index's kind of heads up there. But for the most part, they move in tandem. And that's why this is important, because I don't want to make the bet that these two lines are going to resolve in opposite directions, right? They're going to move together. And why I like this G10 currency index so much is because you simply add commodity-centric currencies, which over the last year, after the US dollar's rip-roaring rally of 2022, commodity-centric currencies were the most resilient. So to see these currencies, when added to the US dollar index, show expanding dollar strength, also kind of speaks a little bit to that weakness that we're seeing in commodities, that broad weakness. And I think that's interesting. Notice the US dollar ZAR. We mentioned this on the show about a month ago. This is one of our charts I really liked. Broke out and hit our initial target of 1975. Now, if and when we get decisive close above that level, I enter secondary objective up around 2150. And this is an excellent example of the dollar taking out an emerging market currency that's deals a lot in commodities. South Africa is a commodity-rich company, commodity-rich economy, and those commodity currencies are falling to the wayside against the dollar. So interesting. All right, so I want to move on to some of my favorite charts today.
Yeah, I see a couple. Well, okay, maybe let's start with the dollar krona, but then we had discussed the chart following that, 2 weeks ago now. So dollar peso, I want
Yeah,
to
we
discuss
can
that
hit
as
a couple more currency charts here. So what's interesting is that the dollar has been catching higher against a lot of commodities centric currencies, except for the peso.
Okay.
This is one of the few currencies that have actually doing well and continuing to do well against the dollar. And it broke down, it hit our measured target. We talked about this currency last week in respect to hitting another logical level of potential support, finding support and beginning to catch higher. And what that signals to me is the potential for increased volatility hitting the US stock market. So
well,
when we overlay those two charts, I didn't bring that chart with me today, but when we overlay the VIX and the US dollar Mexican peso, they practically move tick for tick. The positive correlation between those two charts it's extreme. So whether that equates in an increase in volatility, and whether that volatility is upside or downside volatility, who knows? But if the US dollar Mexican peso digs in here around 1750 and begins to catch higher, then we're most likely seeing, like I said, volatility hit the US stock market.
Well, it's interesting that you mentioned the stock market, and we can move to some of your favorite charts now, because you're looking at some risk on commodity charts, and in the stock market, some of the risk on areas of that market have really been ripping strongly, right? Tech, growth tech, having a tremendous year. But risk on commodities,
not so much.
Not so
much. Right. And that's the message of this chart. Right. So it's a triple pane chart with our risk on index, which consists of copper, the Aussie dollar, junk bonds, and then high beta and semiconductors relative to the broader market. Now, bottomed in October, right? All three of these charts, the middle charts, the high beta versus low vol. So this is a risk on. So when the high beta versus low vol line is catching higher, investors are out there reaching for risk. They're turning away from those low volatility, safer areas of the market, being offensive, not defensive. And then the copper gold ratio at the lower bounds tends to move with US rates. And again, copper, thought of more of a risk on pro-cyclical, positive economic growth asset versus gold, which is often thought of as a safe haven. You tend to turn to gold when things get nasty out there in the market. And that's what's really interesting here, is that the risk on index, it bottomed back in October, while the high beta low vol and the copper gold ratio both bottomed in July. But now that copper gold ratio is printing fresh lows, fresh 2-year lows, while the high beta low vol and the risk on index are catching higher. Now we have a higher low, a series of higher lows for both high beta versus low vol and risk on index. We haven't quite yet gotten a higher high print. Now, again, the big story. I'm sorry, go ahead.
So to tell me what to think though about the bottom two panes on this chart and the fact that they're diverging.
Well, let's start with the top pane, risk on environment. It's developing, right? We're seeing some risk on signals hit the market. Where is it hitting the market? And that's what the two lower panes are all about. The high beta low vol versus copper gold. Now the high beta low vol is telling you that risk on, those signals are coming from the equity market. They're coming from stocks. Now, we're not getting that signal from commodities. It's actually the opposite. So seeing some strength in the stock market and weakness across the commodity space. So it's something to think about. I know we've also mentioned earlier, whether it was on this call or maybe it was the morning show, so much going on out there, constantly discussing markets. But one key theme that's really front and center is the strength in tech.
Yep.
Right. It's just overwhelmingly narrow right now. And, rotation is the lifeblood of any bull market. Right. So want to see some rotation out of tech into other areas like industrials, maybe like materials. Are we going to get that if we continue to see risk off behavior in commodities? Now, I don't know the question, or excuse me, I don't know the answer to that question, but it's what's really weighing on my mind now, because if we continue to see crude oil catch lower, we continue to see just commodities in general, copper break down, and most of the money flow into more defensive areas of the commodity space. Maybe those industrial areas, maybe those material and those value oriented stocks don't catch a bid or struggle to catch a bid. We'll see. Maybe it's not that big of a deal.
All right, what's this next chart? It's showing crude oil and Chicago wheat. Why are we comparing those two?
Because they look so similar, right? They really move in tandem. Again, I think we've talked about this before on the show. I'm not 100% sure why. Does it have to do with ethanol? Does it have to do with just fuel prices? Whatever it is, whatever this connection may be, Chicago wheat has been pointing lower for crude oil for months. Now, crude started to follow. It's starting to chop sideways, but it's moving towards the lower bounds of its range, while Chicago wheat continues to stair step lower. You're going to see here one topping after early 2022, spring of 2022, war broke out. You got that rip higher there in early March, topping formation, breakdown, consolidated for about half a year, broke down, tight consolidation into early spring, or late spring, I should say. Yeah, early spring, around March, another tight consolidation and breakdown. It's just one bearish continuation pattern after the other. As long as Chicago wheat's below 605, I like it short towards 550. If Chicago wheat's continuing to catch lower, it raises the question, is crude oil going to lose that 65 level? My guess is that it will, and that we've got lower crude oil prices on the way. But again, prices got to prove me right? And then finally today, with the S&P 500 challenging that 4,200 level, and now it's back below 4,200. At least the futures are, as of right now, around 4,182. What's interesting is that the emerging market versus U.S. bonds ratio. This is an international credit spread, and it's showing risk on. This is another risk on development. It's putting in a potential higher low here, carving out this multi-month base, potentially resolving higher. Now that would support higher prices for the S&P 500. Again, you can see how these lines tend to move in tandem. Yes, we get some divergences here that ultimately resolve. And you can see, this EMB versus IEF, emerging bond versus U.S. Treasury ratio. It was catching lower heading into 2022. And that really was a heads up that the S&P 500 was heading into a top. Both rolled over together. And in this turning point here last summer, while the S&P 500 made its low here in October, like the risk on, right? Like the high beta versus low vol and the copper versus gold, both risk on ratios, this emerging market versus U.S. bond ratio peaked back in July, or excuse me, bottomed back in July. Higher low, and we've seen a constructive base since for the S&P 500. Now the question is, will these both resolve higher? Seeing this ratio start to carve out this near-term base and catch higher is constructive for U.S. stock market bulls.
Question in the chat from Yako. He's asking about Bitcoin versus gold. Do you ever look at Bitcoin versus gold, or not really, because they trade so differently?
I look at Bitcoin overlaid with gold. I don't look at the ratio of Bitcoin versus gold, but you know what? I'll put a chart together and I'll bring it on Friday.
We'll talk about it on Friday.
Yeah, I'll bring it on Friday. Have a look, and I'll play around with it and see if I find any relationships or any kind of information that I can gain from that.
All right,
Thank you. That's a
Yako.
great question.
Yeah, you have to watch Friday's show. What the FICC does air every Wednesday and Friday at 11:30 a.m. Eastern Time, right here on Stock Market TV. Ian Culley is the head of fixed income, commodities, and currencies at All Star Charts. He's part of the team that is searching far and wide for that one perfect chart to send directly to your inbox every weekday in the All Star Charts Chart of the Day email. If you want to get that email, it is totally free. There should be a link in the description of the video. There should also be a QR code, I believe, on the screen, or a link on. There's a URL on the. I know that there's a URL on the screen. Go to that URL. Get the All-Star Chart of the Day. It's free. It's fantastic. I read it every day. You should too. Okay, I think that's a good place for us to wrap here, Ian. As always, any final words of wisdom for us?
Watch that 65 level in crude. Crude's been dropping hard these past 2 sessions. So keep an eye on.
All right. 65 level in crude for Ian Culley. I'm Spencer Israel. Thanks for watching What the FICC. See you next time.
See you guys.